Hello, and welcome to another episode of The Officials Explain. I'm Ed.
And I'm Will.
And we publish fair value curves for a number of energy derivative contracts at the close of Singapore and European trading.
So today we're going to be talking a little bit more about products. Recently, there's been a pretty aggressive move down in crude, but across a wide range of products, we haven't seen a comparable move down in their kind of outright values, which has led to pretty significant strengthening in a number of cracks and as well refinery margins. So it'd be interesting to discuss that a little bit. Ed, why don't you take us through what a crack is? Why is it important?
So on a high level, you can think of a crack as the product minus the input crude cost. So a refinery takes in crude and then puts out these products: gasoline, diesel, jet, etc. And the product crack for each of those gives you an idea of the margin and the profitability that a refinery can take from producing each of these products. So the reason that's important is it gives you a sense of the health of the refining landscape, and it tells you the relationship between the crude and its products. Recently, we've seen quite a lot of strength in some of the key cracks,
particularly in the RBOB cracks in sort of mid-April. So
so we have the chart here. So you can see from the mid-April area, we have this low down here, and then since then we've been climbing pretty consistently. It's started to come off a little bit now with perhaps some profit taking, but in any case, the crack has been very, very strong despite some product outright weakness. So will you explain why that could be?
Yeah, exactly. So I mean, really, when you kind of consider a crack, you need to break it down into its components. So clearly there, what that chart is showing is the crude is selling off, and we've seen that in Brent. All the global benchmarks really have been taking a beating recently in crude. Products outright, not so much. So if you look at like heating oil contracts, for example, they've been relatively range bound on kind of the outright basis, and that leads to obviously a strengthening in the crack. Some people are suggesting that that's maybe indicative of stronger demand, because of course everything when it comes down to any market really it's a function of supply and demand. So I mean one indicator of the product lagging the crude on the way down might be that you have strong demand for products in the prompt, but nevertheless, a lot of sort of the macro indicators are not suggesting that. So that's been a bit of a head scratcher. Though. I mean, if you look at, this is something that Chair Powell was speaking about in the FOMC last night. Is US consumer confidence is really quite
pretty
bad.
Poor,
really quite bad.
Poor,
a lot of those kind of soft soft data, like the Page book from the Fed, for example, all indicating quite an uncertain consumer, quite a conservative spender. But then like I said, the gasoline crack, which would normally be very responsive to service sector demand, so a lot of consumer spending,
driving basically.
Exactly,
that's what it's for.
Has not been responsive to that. So then it kind of makes you kind of think about the other side. So what's the other side of the crack? The supply side. Sure.
Well, the supply side, you have to consider not how much crude there is, but how much gasoline there is in this sense when you're looking at the product. So this chart shows us the refinery utilization rates in the US, and the blue line is showing you the 2025 year-to-date level of refinery utilization. The light gray range is the 5-year range. And from this chart, we've excluded 2020 and 2021 due to the extreme volatility during COVID in terms of the utilization rates. So you can see really there's a very steep drop off, and we're right at the bottom of the 5-year range, sometimes even below it on refineries in the US.
And you can see there's a very kind of strong seasonal pattern in the five-year average there, and we've really kind of lagged that sort of February uptick as refiners start to ramp up after sort of February March time after maintenance. They'll come back online and ramp up ahead of summer driving season. We're only starting to see that ramp up now in kind of back end of April, early May. So that tells you that there's less gasoline being produced in the US.
Exactly.
And then if you look at the chart that shows gasoline inventories.
Yeah, here we have a chart that the EIA, which is based off the EIA's data, where they produce a weekly report on the inventories in the US of crude and important products. So this is the gasoline stocks. And you can look here, the red dots are this year. We got the average of the last 5 years in the dotted black line. So they've been falling pretty rapidly, really. And that tells you that the demand for gasoline is pretty strong. Combine that with the weak or the low production, the low refinery utilization, and you've got a pretty potent cocktail for the strong gasoline.
Yeah, well, I mean, it's interesting you say that. The demand for gasoline may or may not be strong. For me, this is more of a supply indicator, really. We've been in those low run rates, and obviously inventories are the balancer between supply and demand. If you have greater demand than supply, then you'll draw on inventories. If you have greater supply than demand, then you'll build inventories. So it really reflects the combination of the two. And given that refineries are not running, that tells me that the retail demand isn't actually particularly good, or at least it hasn't been, and we're only just starting to see that seasonal uptick now. Often refineries will optimize, so they will look globally at the various crudes they have, factor in the cost of shipping, and then they'll look at how much they can sell the refined products for. And through like a linear programming model, they will optimize the slate of crudes they run based on the yield they produce. Given that refiners are kind of running at this kind of really historic,
pretty tepid pace,
low, that tells me that their forward margins maybe weren't looking so good. And also you've got to remember as well that refiners, they rarely will run at 100% capacity.
You then run the risk of damaging your equipment, which means you enter unplanned maintenance and you lose time effectively producing your goods. So there is a risk.
And then in Europe as well, the story has been similar. In the US, to me, it looks more like a supply story. Kind of, we're down at the bottom of the range on the inventories. Refinery run rates are towards the bottom of their kind of seasonal range. In Europe, I think it's a similar story as well. We've seen recently Dangote went out. We've seen a series of unplanned maintenance on various FCCs, which are kind of a bolt-on component to your refinery that is used to produce a lot of gasoline. They've been in unplanned maintenance. So that's a supply factor that the market wasn't necessarily ready for. And that's driven a lot of tightness in the cracks, which is now actually doing the opposite, right? It's incentivizing some refineries to increase their run rates.
It's a balance, because you do then get this economic incentivization of running your refinery harder if you've got this strong margin. And then by running refineries harder, you end up producing more of the products. That can then have an effect on the balance and bring down the margin. So it is a fine balancing act, and there is a lot going into this. It's not a simple one-for-one binary system. It's quite a complex balance.
Definitely, and it's you need to consider the fundamental macro picture as well. You need to be paying attention to the macro data releases. What's coming out of the Fed? It looks like they're going to be on hold for a while now, so interest rates are going to be high. That affects not only consumer demand but the cost of storage for oil as well. So all of these factors will impact, but you also need to be looking at the other side of the equation and paying attention to inventories in the global balance. But in terms of where next, where do you think where do you think cracks will be headed next?
I think we've perhaps seen.
Let's focus on RBOB.
On RBOB, I think we've seen that very good run. If we look back at the RBOB chart that we were looking at earlier, you've seen this very, very strong run from mid-April into early to mid-May. And for me, it looks like it's running out of legs. We're hearing a lot more about US refiners who are beginning to ramp up their utilization rates, as we saw in the chart. We've heard Marathon, for example, has said it's going to increase its utilization rates in Q2. So with this being a forward curve, obviously this is a future crack. So it's referring to the July contract. That means that I think this will start to come down as the supply increases, and if there's little to no kind of recovery on the demand side, there's not much telling me that this strength can continue. So I think there is definitely scope for it to cool off a bit.
For sure. I think there's also another factor at play here as well, which is kind of the more kind of financial spec side.
Yeah.
We had Trump obviously come out and impose pretty extensive tariffs, which will hit freight. So a big trade recently in the hedge fund space has been your gasoline heat, buying gasoline heat. So that is buying a gasoline contract and selling your diesel contract.
Yeah.
A big driver of demand for diesel is going to be freight, and in a protectionist kind of regime, typically your demand for freight will reduce.
Yeah. If you're importing less,
exactly,
naturally there's going to be less shipping. Yeah.
Naturally, that will lead to that has led to pretty strong support for the RBOB crack. We've seen similar strength in the heating oil contract, but the heating oil crack, sorry, but that has since reversed actually, more so than the small reversal in the RBOB there.
Yeah.
So yeah, it'll be interesting to see how that side of the equation unfolds as well, because you can pay attention to the fundamentals, and a big hedge fund can disagree with you, and
if someone's got more bullets than you,
exactly,
then they can do a lot of damage.
Exactly. So yeah, I agree. I think there's room to the downside, although it depends on the potency of driving season. As we come into the
it does. So that'll be definitely one to watch.
Yeah.
So that brings us to the end of this episode. So thank you for watching, and do make sure to subscribe and follow us on Twitter. Look at Jorge's LinkedIn to read our reports, and we'll see you in the next one.
Thanks for watching.